My next guest has 3 names she's buying and 1 she's avoiding from that list. Joining me now is Gina Sanchez. She's the chief market strategist at Lido Advisors and a CNBC contributor. She is on set, which is so nice. Welcome.
Thank you.
Great to have you here in person. All right, so your first buy is actually Berkshire Hathaway. Tell me why.
So one of the things we're looking at to survive a lot of the volatility that we're experiencing, and today is one of those days, is quality. And Berkshire Hathaway is one of those stocks. It's not just value, it's also quality, it's dividends, it's got the components that we think investors need right now.
Profits, and it's been up this year. I think today, with this 2.6% drop, it's now turned negative by 2% year to date. Still, a lot of people will take that. Berkshire is also a name that had been out of favor. Yeah. Not that it had done that poorly, but it just wasn't ARK K, right? Kathy Wood was the new Warren Buffett. Does this name have staying power?
Berkshire, absolutely. I mean, I think that if you look at the holdings that it has, this isn't a one-time event we're going into right now. This is going to last for the next 12 to 18, possibly 24 months. And so the demand for quality, the demand for cash flow, the demand for dividends, that's not going away anytime soon.
All right, so Berkshire Hathaway is the first one that gets your vote for a buy today. The next one is Mr. Cooper. It's a stock we don't talk about often, but they're in the residential loan market. It's a smaller cap stock, about a $3 billion market cap, hanging on to gains for the year of less than 1%. Why do you like this one?
So this is an interesting one because right now everybody's trying to figure out how to keep kind of their portfolio in order with rising interest rates. And obviously a mortgage dealer does not fall into that natural category. However, Mr. Cooper, most of their income right now is actually coming from mortgage servicing, which actually does quite well when interest rates rise. So it's a natural hedge against this interest rate rise.
We actually had talked to the CEO about this. He was making this case, and the market has kind of borne it out that this can be a place to hide. Don't some of the other mortgage stocks have servicing businesses that could help them? I mean, they don't seem to have gotten a lot of credit for it.
They do. They're just simply not as large. Over 40% of the revenue stream of the business book, the book of business for Mr. Cooper, is mortgage servicing, and over 71% of their income right now is coming from that space. So they're just simply more amped to that, rate hike hedging scenario.
Even if the housing market gets worse, you think this one's okay?
Well, you still have to keep servicing. I mean, that's the thing. Even if mortgages dry up, servicing doesn't stop.
So, yeah, it's servicing doesn't stop. The music don't stop on that front. Okay, so your final buy, so that was first Berkshire, then Mr. Cooper. Merck rounds things out. This one, the healthcare sector, it's been okay, but not great this year. But Merck is actually up about 13%, which is pretty remarkable. Yeah,
Merck has had some incredible hits. Obviously, their COVID treatment has been a huge hit. Their cancer drug, Keytruda, has been just a knockout, and that's been enormous. They're also sort of knocking the lights out with Gardasil, the HPV vaccine. And this, again, is one of those recession-proof areas. The need for these drugs does not go away with a recession. And so, again, getting back to putting a portfolio together that's going to survive the volatility, something that can make it through the recession, is important.
Are there other names in healthcare that you would also like, or do you have to be pretty careful?
We do have other names, actually. We own AbbVie in Lido's portfolio as well, and that's a stock that we really like, and we've, held that for all through COVID. Mm-hmm. There are definitely, it's an industry that's known for being somewhat recession-proof, but you also want somebody that's turning out some good pipeline drugs.
Yeah, well, they have a track record, right? Mm-hmm. They can at least draw on that. All right, so those are your buys, all 3 of them, but here's one you want to bail on. It was a comeback story, up 11% this year, paying a dividend of more than 5%. Our friend AT&T over here, why not a buyer on this one?
So we think that part of the boom that you're seeing right now in the stock price really is a little bit of financial engineering. The spinoff of Warner Media really goosed what they look like, but ultimately this is still a dying industry. We think that the long term is stacked up against them. And so if you're doing well, you probably want to take some of those chips off the table.
We spoke to an analyst on Power Lunch last week who was very bullish on all of these names, AT&T, Verizon, T-Mobile, actually making the argument that they are sort of recession resistant because this is a hard place to cut back on.
I agree with that story, that people will basically get rid of everything before they get rid of their phone. And I agree with that. However, this industry is not charging anymore anytime soon. If anything, data rates, phone minutes rate, we don't even pay for the minute by the minute anymore. Everything is going down, meaning that the odds are stacked against them. Yes, people will hold on to their phone, but now you can get a Google phone phone for $20 a month, right? So you do have to think about whether or not these, these traditional wire service providers are going to be able to survive.
Yeah, and maybe that's where inflation becomes more of a foe than a friend. Not that it's a friend, but if you finally push people to the point at which they have to cut back, they might look at, like you said, the Google phone or other options out there.
Absolutely.
5% dividend yield or more in some cases. Are there other dividend names that you typically would feel excited buying at those levels, or is that a red flag for you?
Well, right now we think it's a little bit of a red flag. I mean, we think, again, that there's some financial engineering going on. And quite frankly, if you look at the balance sheet of AT&T, that's really where the real red herring is. Right now, they're carrying debt loads of, even after the spin out, of up to 3 times current EBITDA. Right. And if you have to refinance that, that could be quite expensive for them.
True. So with that in mind, I should say the impact of what we're seeing in the market today, spiking rates, sinking stocks, where does that leave you just strategy wise for the remainder of the year now?
So, we're looking at, we believe there's still another leg down to the market. And we think that that leg down comes with a series of very likely earnings revisions. So we have to see a round of earnings revisions. And so right now we look like the markets could be sustainable, trading at 17, 16 times. I mean, that's a great price for average market stocks. But we think after the revisions, it's going to go back up to 18 times. So we're going to have another leg down before we get to that sort of bottom where everything looks attractive again.
Right. And we had a guest top of the hour who said she thought maybe we were kind of at the top of the range for the 10-year yield, and that, as we move throughout the cycle, that starts to move lower again. That's a tough call to make right now. And I just wonder, for those who might have listened to that and said, I'm not so sure, what would your advice be?
Well, I think that everyone's looking at the Fed even harder right now, because now Fed fund rates are having an overreaction, pricing in 75 basis points. That would be a shock to the market. And if anything, what we believe is that the likelihood of a policy mistake, the Fed going too far, that pushes us into recession, we think that's where it comes from. Right. And so there's still room. If you were to see that happen, the yield curve at some point would invert.
Right. And do you think you have to have a view on whether the 10 years above or below 3% on stocks this year, or are they just going to struggle, to your point about earnings regardless?
I think they're just going to struggle. I don't think that we can see, for example, the 10-year really get significantly higher. If, in fact, we got to where the Fed funds futures are forecasting, right now we'd have a flat as a pancake curve. Everything would be 3%.
Yeah.
Front to back.
True. Absolutely. Yeah. Not what you typically. Next time we need cappuccinos, I think, for this.
Know.
And maybe a better tone to the market. But anyway, Gina, it's really great to have you here today.
Thank you.
Thank you. We appreciate it. Gina Sanchez.